Bloomberg Audio Studios.
Podcasts, radio, news.
Short and simple, a change in the statement, but no change in rates. The economic overview remains the same, word for word, with solid growth, strong job gains, and inflation that's eased over the past year, but remains elevated. And then a new line. In recent months, there has been a lack of further progress toward the committee's 2% inflation objective. Still, the statement says risks to achieving its employment and inflation goals have, quote, moved toward better balance over the past year, putting the assessment in the past tense and adding over the past year. The additions to the statement would seem to ratify the market's view that there will not be 3 rate cuts this year, if any at all. The statement's view that the committee does not believe it would be appropriate to reduce rates until it's gained further confidence inflation is moving toward target is unchanged. Now, the long-awaited balance sheet taper is here. The Treasury roll-off cap will drop from $60 billion to $25 billion a month starting on June 1st. Officials had suggested it would be lowered to $30 billion. As expected, no change in the $35 billion cap on mortgage-backed securities. However, any maturing securities over the cap will be reinvested in treasuries rather than MBS. The vote, unanimous. And that's it.
Mike McKee, thank you, sir. Stay close. Let's run through this price action. Mike McKee's going to run into that news conference in just a moment. Equities recovering just a little bit, still down on the session by 0.1%. Your attention, of course, immediately turning to what's happening in the bond market. In the bond market at the moment, the rally sticks. Yields are lower by 4 basis points on a 10-year, 4.64, on a 2-year down 3, just about holding on to that 5% level. Lots of attention in the FX market and what's happening with dollar yen. Bit of yen strength off the back of this. Dollar yen back down to 157.54. It was always going to be difficult to out-hawk what was already very hawkish pricing in this market. Bear in mind, though, this is the first act of a 2-part story. The other act is in about 28 minutes' time when we hear from the Federal Reserve Chairman. So do you want to play compare and contrast? I think we could do that, Bramo, briefly. I'll go through this. It might sound a little boring, but every word seems to matter. The last statement, the first paragraph, read as follows. Recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained strong and the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. That first paragraph has changed. This is how it reads now. Recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have remained strong and the unemployment rate has remained low. Inflation has eased over the past year but remains elevated. In recent months, there has been a lack of further progress towards the committee's 2% inflation objective. I just wonder how long the conversation was, Bramo, in the FOMC to agree to that last line of that first paragraph.
You know, I wonder, because the discussion among Fed officials who did speak in the week before the quiet period was more hawkish. People seemed genuinely concerned. I don't think that maybe there was disagreement with this. I just wonder how much conviction Fed Chair Powell will have in this news conference to really build on that and say just how much less conviction they have and just how much they're going to do to offset some of the lack of progress.
I think they've got to wait for more economic data. And the bottom line, John, you quoted off Jobs Day. Do we link right now to Friday's Jobs Day? I'm sorry, we do. There's no real indication here of the labor market cracking. JOLT survey today was a little weak. Bob Michael mentioned that, but I just think they have to wait. They're in massively ex-post position.
Fantastic lineup going into the news conference. Bob Michael's still with us. Joining us now, pleased to say, good friend of this programme, good friend of ours, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, you've had a few minutes to go over this one. What jumps out?
3 things, John. One is the characterization of growth is stronger than I would have expected. 2 is the reduction in QE is larger than I expected. And then finally, that additional sentence they've put in about inflation is going to put Chair Powell in a difficult situation at the press conference, because people are going to say, okay, finish the sentence. The progress hasn't been achieved. Why? Is it something temporary? Is it something structural? So they've left wide open the question of why has progress been less than they expected on the inflation front.
Mohammed, if I look at this press conference, this is a central banker with an original script and not much theory involved at all. Can he get out front of the debate ex ante, or is this an ex post discussion?
Tom, I'm really glad you raised it. This is an ex post discussion. This is a Fed that, having been burnt by trying to be ex ante back in 2021 has become totally exposed, totally data dependent, totally reactive. And that is a problem for the economy. That is a real problem for the economy. So no, he's going to remain exposed. We're going to hear data dependency, I don't know how many times during the press conference.
Which raises this question, which data matters more? We were talking about data that we got earlier this morning about ISM manufacturing showing weakening activity, to your point about the surprise and how much they had conviction and strength, but also stickier inflation that came in higher than expected with prices paid. How will this Fed view that data? That I don't want to say stagflation because I've said it so many times and I'm sure people will be making fun of me for that. But I am wondering if this is sort of not ideal for them and if they'll respond more to the inflation side or the economy side.
So I call it stagflationary wins.
Thank you.
Okay?
That's good.
How I call it. I can live with stagflationary light that you used, but stagflationary wins. They're not going to acknowledge that because it puts a question front and center, which is what is the right inflation target for an economy that's going through fundamental supply side changes. If you look at what is sticky in inflation, it's not particularly responsive to higher interest rate for longer. It really isn't. So if they acknowledge the softer economy, they end up having to then discuss, at least internally, whether 2% is a right inflation target. And a phrase that John did not read out in the statement is they are strongly committed to returning inflation to its 2% target.
Give me a chance, Mohammed. I was just itching to get to you, to get your reaction. Bob Michael with us as well. You're going to run with that phrase.
I think Hilarion just threw you under the bus.
I think he did.
I think he
did.
You failed, John.
Can we get Mohammed back up? I was going to turn to Bob Michael and get his thoughts.
What's great about this is you at least read the statement.
Hold on a second. But that was in it before. It wasn't the more notable thing. It wasn't struck out. It didn't change, John. That's the reason why.
Fact, I've never read a statement. Continue.
I believe you. You didn't even need to tell us that. Mohammed, what are you doing to me? I don't know. Bob Michael, great friend of this programme. Bob, good to see you.
Thank you.
Bob, your thoughts on this one?
As Michael McKee was reading through the commentary, I thought, boy, this is really good for the markets. Because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there. I actually think that's the right message. I don't believe the law of long and variable lags has been repealed. I think they've been delayed because of all the fiscal stimulus that's still in the pipeline, but they're still there. You are seeing some pressures on the economy. Like Mohammed, the only thing I was surprised about is that they characterize the economy as still solid.
Yeah, look, Mohammed, I want to bring this up. I brought it up earlier with Bob Mike. I'm going to do it with you right now. I don't know where you were in 1995, maybe at the White House, Mohammed, maybe IMF. But the answer is Bob Michael says there's whispers here of 1995. The stock market was a moonshot off of the success of 1995. Is that what we are prepared for here, that they may get this right? We may have a constructive 1995 and up we go?
So where I agree with Bob, without any qualifications, is that this particular statement is something that the markets will like. It's exactly what the market wanted. As to, are we going to repeat 95 in terms of market reaction? Tom, what I'm worried about, because I truly believe that this is not about lags, that there are structural aspects that are running the equilibrium inflation rate higher than it has been in the past. I worry that the Fed is going to be over tight this year. I worry that the Fed is not going to end up cutting because they're going to be so data dependent, so reactive, that they're not going to look at the weakness that's coming. In fact, if you simply read the earnings reports of McDonald's, Starbucks, PepsiCo, Nestle, the list goes on, there is no doubt that low-income consumers are struggling. Their balance sheet effects have gone from positive to negatives. The pandemic savings are run down. Their credit card balances are high. They rely entirely on the labor market, entirely on wage income. And if something goes wrong in that labor market, we are going to see this economy slow much faster than anybody would like it to slow.
Walmart as well, talking about a loss of pricing power. We've been talking about that over the last few months or so. Bob Michael, I'm pleased that Tom brought up the mid-90s. You've talked about the mid-2000s. You share those concerns about economic weakness, cracks starting to build, yet you are still bullish as you have been since the mid-2000s. Could you explain why?
Well, I think Mohammed's right. I think you have to watch how businesses are reacting in this environment, and there are some pressures. I think what we need to watch is the unemployment rate. Does that start to go above 4%? And certainly at 4.2%, it would get the Fed's attention, and they would do something as long as inflation is reasonable. And what they did in 95 is come in and cut rates 3 times. As I said, that's the one soft landing that I've lived through in my 40 plus years in the market. It looks like it's doable again, but it can't be a Fed that sits on the sidelines the entire year and leaves real yields where they are.
I have to give you a victory lap, Bob, because you basically said that this is what they might do to kind of give a nod to a little bit more of a dovish stance while having a more hawkish stance in the actual statement, which is maybe essentially what they're doing, which is the reason why the market might like this. I am wondering, though, to Mohammed's point about stagflation light, or the winds of stagflation, that they're not going to address this. They're going to talk about strengthening the economy so that they don't have to address that maybe they're looking at a 3% target of inflation rather than 2%.
Powell's probably laughing every time he hears stagflation because he remembers, and he's probably thinking what I am. If Volcker would hear, here we go, 2.8% core PCE year over year, this. I would take that in a second. And if you go back to 95 to 98, which Tom points out was great for markets, inflation traded between 2.5% to 3%. Yeah. It was a pretty vibrant economy. I don't know what markets will do. I think that kind of economic scenario is realistic.
I mean, John, X 1998 was a moonshot. The Dow went from 4,000 to 10,000. Just, I remember this.
Somebody's looking to get out of triple leverage. That's what I'm doing.
I'm looking for the first trade out of triple leverage cash.
Today's the days. Today's the day. Bob's got some bonds to sell. Diane Swonk joins us now, chief economist at KPMG. Mohammed and Bob are going to be sticking with us. Diane, you've had 12 minutes to go over this, going into the news conference with Chairman Powell, 18 minutes away. What's your big question for him after reading that statement?
Well, one of the things that I'm surprised at that they could have gone more hawkish on, and I think the nod to inflation picking up more recently was the compromise, is that they left it, they're waiting to decide when to reduce rates. And you've got to believe within that meeting, given that we've heard that it's a possibility that we could see rate hikes if inflation persists from Fed leadership themselves, that to keep that line, reduce rates, when they're going to reduce rates, that they still think the threshold to raise rates is much higher than the threshold to cut rates. I think that's where the bias is within the Fed. However, what I'll be looking for in the conference, the press conference, is was there debate, and in the minutes to this meeting, was there debate about the possibility that they might need to raise rates? Now, I think the move up in inflation we've seen is been somewhat overstated. We know there's some residual seasonality somewhere between the fourth quarter and the first quarter's reality. That's still too hot. And what we saw in inflation was much more broad-based inflation in the service sector. Things like home maintenance, car maintenance. It wasn't insurance as much this month, but those are things that Mohammed talks about, less retractable and also more systemic. But there was service sector inflation in the employment cost index as well, not in the lowest wage jobs, particularly in food services and accommodation, where they've been decelerating quite rapidly and are now trailing overall inflation numbers. But in the overall services sector, where we do have some labor shortages still pretty acute, there is wage pressures there, and that's what the Fed's going to be focused on.
Diane, the Diane Swonk charm is you're not living within 3 zip codes or some fancy university in the United Kingdom. Diane, just simply put, if you drive 7 hours south of Chicago, what's it like right now? Because I see with all the mail I get, what you get out on LinkedIn, is there's a massive divide right now between the financial people and the rest of America. What's it like south of Illinois?
Well, what's really interesting is they've just done a study on this in terms of how different people view what the inflation problem is. Wealthy households, those in the urban areas, they tend to view the entire inflation problem as completely the fault of the Fed. Those who are less wealthy see this as price gouging. They see this as an inequality issue, and we still have gross inequalities. Even though we had this massive leveling up of wages, even for low-wage workers, as I've said before, they moved from the shadows of the economy into the sun only to be burned by inflation. And that inequality, and even though wealth picked up, we saw across income strata, that wasn't enough because inequality continued to worsen. And I think that's what you see when you're dealing with this kind of inflation, even though it's at a low grade. And I wouldn't compare it to 1995. 1995, the Fed was wrong in 1994. Chairman Greenspan had a checklist. I remember it well. And it filled it out, and he thought he could preempt inflation. And he was wrong, and he nearly derailed the economy. That was not coming off an inflationary kind of situation that we have today. It's just not comparable.
This raises this question, and Mohammed, I'd love to get your answer since you live within a couple zip codes of a fancy UK college that Tom was maligning. I will say I want to hear what you have to say about this idea of the messaging of Fed Chair Powell in the press conference. Do you think he needs to be hawkish, that he needs to keep the market under pressure in order to keep them on this goal of at least even having the cover to cut rates this year, as you think is necessary, as they want to do, but under the auspices of data dependency is difficult without some more cracking?
I think the most important thing, Lisa, for him is to stick to what actually happened in the meetings and not end up like we have in the past, where his messaging is different from the messaging from the minutes that we're going to get in a few weeks. Because if that happens, that is going to cause too much volatility yet again, confusion, and is going to erode forward policy guidance. If what he says is, in fact, what was said in the meeting and is confirmed by the minutes, then what he should do is stick to where he is right now, which is not validate the amount of the hawkish pivot, if you like, that the market has done, not go all the way, but go some of the way. You know, my concern is ultimately he may end up more hawkish than he needs to be for the well-being of the economy, but that's more for the next meeting than it is for this meeting.
Diane, your view on that? Do you think that he's going to come out maybe more hawkish than he needs to be as well?
I think he is. I think that is the risk, and it's because the risk has been on the other side. And Mohammed's exactly right. It's very hard. These press conferences, having them every single meeting, there is a downside to transparency. We see how the sausage is being made, but you also see individual personality of the chairman himself and his own views and how that gets translated and gets muddled in terms of what the overall messaging is. And it's not that he's a bad communicator, but it is that this is really hard. I think one of the things that I get really frustrated with is how little uncertainty the leadership of the Federal Reserve have really shown about the economy. I think Chair Powell has actually been more humble in that regard because he's had to eat crow in public on this issue. But the humility and uncertainty we face is very high. And that, the sort of, coming out and making statements following the meeting to counter or to change the message or reflect the message that was in the meeting, I think is not productive. But it's also the certainty with which some of these comments are made is really not helpful either, because there is a lot of uncertainty. Let's face it, we were at 2% on the Fed's, run rate for 3 and 6 months on core and overall inflation coming down. And people were arguing that they should be cutting like crazy. And the Fed, at least in a prescient manner, said, let's be cautious here. We've been, fool me once, shame on me, fool me twice, shame on you, fool me twice, shame on me. They said, no, I'm not going to be head faked by this again. And they held back. That was good to hold back because, in fact, we have seen an acceleration. It's probably overstated, but we've got to see where we're going. And there is time with the lags that are already still in the market with regard to Fed tightening.
Diane, this was great. Diane Swunk of KPMG. Diane, thank you. Talking about humility, you've got to remember 4 months ago, we had people on this programme talking about cuts in March. This was a Fed that was meant to be already cutting, and now there's a conversation about him at least entertaining the potential of hiking interest rates. Mike Gapon of Bank of America with us now. Michael Gapon, I keep hearing that Chairman Powell's going to be hawkish. Could you define for us what hawkish will sound like in this news conference, given you, like others, think that the first cut comes in December, which is not anytime soon?
Yeah, I think hawkish today simply is a wait-and-see message. We need to give policy more time to work. That's really about as far as I think they go today. I think he can repeat or will repeat their view that the supply side is helping bring inflation down. So inflation's still in a downward trend. Progress hasn't been where we wanted it to be, but we think our policy stance is tight. So the answer is let that tight policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
Bob Michael, are we back to normal? Are we beyond the pandemic? Are we talking about fixed income dynamics, Fibonacci 101, that makes sense now post-pandemic? Or are we still living the debris of what we had for 3-4 years?
No, we're still in the shadow of COVID.
I strongly agree.
There's still stimulus that's being distributed. When we talk to our municipal research team, they're talking about state and local governments accessing it, going out, doing some hiring and spending it. When you talk to businesses, they're talking about accessing some of the Infrastructure Act, some of the CHIPS Act. So that money is still there. When you look at consumer balance sheets, deposit balances on averages are still a little bit above where they were pre-COVID. So it's still sloshing around a little bit, but it's coming down pretty quickly.
Which raises a question about long and variable lags and exactly how the Fed views that. Michael Gapin, I'm curious about your view about whether this is a Fed that has yet abandoned that or not, considering the fact that so many people are saying this is an economy that can live with higher rates. This has been the evidence of it, is the strength in the market, the strength in debt markets in general. Do you think that they're going to go there, or that it matters in terms of their faith in long and variable lags?
I don't think they'll go there in, say, great detail today, but I agree with some of the comments that Bob made earlier about long and variable lags kind of still being in the pipeline. I think some parts of the economy reacted very quickly to higher rates. Others, it may still be in front of us. So things like fixed rate mortgages, the effective mortgage rate only rising very little, corporates needing to refinance at some point. I think you can make a case that some of the monetary policy tightening is still in the pipeline. It's just been elongated. I doubt that the chair is going to get into that today, although I think it's a very reasonable question to ask him, in light of inflation in recent months. Is your policy stance as tight as you think it is? If not, what are you going to do about it?
Are they sufficiently restrictive? Mike Gapin, just a final question from me, one to explore. I think we've spent the last month or so trying to work out how this Federal Reserve is going to respond every single day to upside surprises. Could you entertain us just a little bit? Just indulge me. How reactive will they be to downside surprises? I'm trying to understand. You get a downside surprise on Friday. How quickly will this conversation change? Will we be sitting here talking about cuts all over again?
I mean, I think you'd probably need a number under 150 to get that discussion on the table. If consensus is right in that 240 to 275 range, you have to majorly undershoot that. You need something that changes the overall narrative. And people like me would need to say, it looks like the catch-up effect in services employment is done, is over. So the labor market looks fundamentally different. It's a pretty big hurdle in my view.
Mike Gapin of Bank of America. Mike, thank you, sir. Great to catch up with you.
Thank you.
Mike Gapin and Bank of America, base case, December is going to be that first cut.
Wow.
Mohammed, I want to come to you on that. You've talked about how sensitive this Federal Reserve is from data point to data point. Do you think this has the potential, this conversation has the potential to change and change quite fast in the other direction?
I do, John, because they're so reactive. I mean, the one thing we didn't talk about, and Tom talked about the 90s, is the economy is changing both domestically and internationally. The 90s was about deregulation, liberalization, and fiscal prudence. Today, it's about re-regulation, heavier government intervention, and fiscal irresponsibility. The 90s was about globalization. Now it's about fragmentation. This is a significantly different operating environment. So the risk is that you miss all those signals, and you end up reacting too slowly to what's coming up. I smiled when I heard Bob say, well, it's very easy. If we get all these bad numbers, the Fed can simply react. But by the time it reacts, the harm has been made. It's a little bit like being on a plane where the pilot is reacting to past turbulence. He's just going to add to the turbulence in the short term. So there is an issue about having to step back and ask the question, what economy are we operating in, and where is the balance of risk for this economy?
Which has been a big debate. Bob, what's your take on that? Do you agree with Mohammed that maybe they should move quickly if they start to see weakness? Unclear what they will do.
it's already there, some of the weakness. When you look at consumer sentiment, consumers are frustrated. They're having to make choices on where their dollar goes. They're going down brand. When you look at the housing market, home affordability is a train wreck, and you look at existing home sales, they're low. So the consumer is feeling the pressure. You look at middle market corporate America, their cost of funding went from, call it 6% to somewhere around 10 to 12%. And that's what they're paying, and they're feeling the pressure of higher input costs. That's really strangling their margins. So a lot of it is there, a lot of it is slowing down. Maybe that's some of what we saw in first quarter GDP, I don't know, but we're going to see more of it. If you look at the unemployment number, for me, if that starts to go above 4%, that's really going to get the Fed's attention.
Dr. O'Leary, I got to be real quick here, but I think it's timely with college protests across America. I'm not sure what's going on at Cambridge, but I want to be very clear here, Mohammed, on Joe Stiglitz's book, The Road to Freedom, Economics in the Good Society. Is Chairman Powell today going to speak to a fractured America, to the polarities of America, or is this basically to the financial audience?
I think he's gonna speak to everybody in the beginning when he says that the Fed is committed to the well-being of Americans, all Americans, etc. But he's going to stay a mile away from what's going on college campuses.
Yeah, he might not say a mile away, though, of the fact that they are not necessarily going to be focused on the election. And Bob, do you have the sense that if they do not cut rates in July, they only can go in December because of the potential election questions and political interference?
No, I've had enough conversations with former Fed officials that if they need to go in September, they will go in September.
What does need to go look like?
Exactly.
Yeah. For us, it is rising unemployment. Yeah. It's something about 4.2%.
That's the threshold.
That's it.
Break into the fours. Mohammed, would you agree with that?
I would. I think Bob is right.
Get into the fours, they start to cut, 25 basis points, or they start to freak out?
Well, it depends what else is going on, because Mohammed is right. Once this starts, it tends to escalate very quickly. So if you're going to make that first cut after waiting so long, why not do 50?
Mohammed, I'm just curious what your question would be to Fed Chair Jay Powell at a time when a lot of people are just saying simply, what would it take for you to hike rates? What would your question be?
The one thing we haven't talked about at all is, what is the terminal rate? Where does he think we end up? You know, we talk about the journey, but will someone tell us where the destination is?
Will you tell us what you think the destination is, Mohammed?
I think it's significantly higher than what the Fed is saying right now.
They're at what, Mohammed? 2 and something? 2.5?
Oh, no, I think we are above 3 in terms of, yeah.
You think we're closer to 4?
Yes, that's what I think we are.
Bob, how do you do quickly here? Bob, how do you dovetail with that with Ferroli's potential GDP under 2%? How do we have a run rate above 3%, as Dr. Larian talks about, and JP Morgan's publishing out an economy that's a little bit beneath that, to be kind?
Everything goes in stages, and a high real Fed funds rate is going to slow things down. The Fed will pull back the Fed funds rate. I agree with Mohammed, maybe something like in that 3.5% to 4% bracket. I think 2.6% is a fantasy. That will create enough stimulus that things will pick up again. So it's going to come in cycles again, as it always does.
Begs the question, if it is a fantasy, why are they adjusting that? Do you think that's just something they don't want to engage with at the moment? Have a debate about where that long dot should be? Is that what that's about?
Well, my question that Mike McKee should be asking is, have the dots outlived their usefulness? I believe they have. I think they should do away with it. I think in 2012, when they were in completely uncharted territory, they helped for a very brief period of time.
Bob Michael of JP Morgan, to the brilliant Mohammed Al-Erin of Queen's College, Cambridge, to the both of you, thank you very much for being with us.